Okay, so this is the last of our videos on economics. This one we're looking at monetary and fiscal policy. Looking at the exam papers, I have seen questions covering these topics a few times coming up, so I think it's worthwhile to ensure that you have a good understanding of what these are about. So, first thing is obviously to try and make sure that we understand the definitions of both of them and where they are different. So both of them focus on controlling inflation and the level of growth or the rate of growth in the national economy. So how much are we spending, whether inflation's rising too quickly, not rising enough. And that is regulated by both the government through the Treasury and through the Bank of England. So monetary policy, first of all, is the policies adopted by the Bank of England, by the central banks of the countries, and their policy influences how much money is available in the country, so the supply of money, and they will also look at the interest rates of the banking sector, not just the interest rates they set themselves, but once they set an interest rate, the idea is that the commercial banks will follow suit. Conversely, when we're talking about fiscal policy, we're talking about the government policy, and with things like that, we're looking at how the government spends its money, what it might be trying to do by spending in the public sector or making cuts. And they will also have their own tax policy, so how much tax they're charging, what's being taxed, what's being more heavily taxed. So for example, hot topic just now would be the sugar tax. So the fact that they want to affect health and lifestyle, they're saying that we're consuming too much sugar, so they have imposed a tax on sugary drinks. So the idea is that that may shape behaviours, but also obviously if there's an increased tax and people continue to buy sugary drinks, then they will increase the amount of revenue that's coming in. The government will get more money from these taxes. So just to recap, monetary policy is the policies adopted by the Bank of England. If we're talking about fiscal policy, we're talking about the government agenda and what the government's doing. There are some connections between the two of these, but I think it's important to be clear in your own heads about which one's which and to see them as being distinct from each other. So first of all, looking at monetary policy, the central bank is effectively it's the bank of the government. It's the country's bank, and they will provide money to the government. If the government needs money and it doesn't get it through taxes, it would come to the Bank of England, which is the central bank in the UK, and borrow money from that. So you have examples of central banks in other countries. So in America, I think it's the Federal Reserve that sets interest rates. And in Europe, it's the European Central Bank. Okay, so the role of the central bank, as I mentioned already, is to manage the supply of money in the country and to manage interest rates. It uses how it manages those things. It uses those to control the level of inflation. It will control consumption. So the more we buy, the more we're spending. Sometimes that can cause inflation to rise. So if they want to stop us spending, they may either reduce the supply of cash in the country, the amount of currency available, or they may increase interest rates. If you're having to pay out more in interest rates, then you perhaps will have less to spend. So they will control the amount of consumption. We'll sort of slow that down if they think it's increasing too much, then they'll try and slow that down. On the other side, they may want to try and encourage more spending, encourage the economy to grow, and therefore they might bring down interest rates, or sometimes they may put more cash into circulation, and we'll talk a little bit more about that later on. Liquidity is the amount of cash available in the currency, so they may control the amount of liquidity, the amount of cash available. When we talk about liquidity, that's what we're talking about there. It's important to note that within the UK, the central bank, the Bank of England, has been independent of the government since 1997. Prior to that, interest rates in the UK were dictated by government. If government wanted to influence public opinion, they may drop interest rates prior to an election to encourage people to vote for them, for example. So to ensure that the Bank of England had more control over how it managed or controlled inflation, interest rates, things like that, they were given independence from the government, so that in a general rule, there are some very minor exceptions, but generally speaking, the Bank of England is independent. It does not, it's not influenced by the government when it comes to setting its interest rates. So the Bank of England should be looking at what's happening in the economy, what our inflation rates are at. The government may set an inflation target, and then the Bank of England has to manage policy to achieve that. But assuming that that's what they're doing, they're looking at, the government says we have to have 2.5% interest rate inflation, for example. They will then manage their interest rates to make sure that we're achieving that. So if our inflation's too low, they may reduce interest rates to encourage spending. If spending's too high and inflation rate's too high, they may increase interest rates to bring the spending down. I hope that's clear enough. So fiscal policy is, as I said before, the government policy. Is what the government do to manage their spending and the amount of money they have coming in to spend. So what's the government trying to achieve when it's doing these things? Well, it's trying to promote strong and sustainable growth, making our economy healthy, making it a good, prosperous country to live in. Though at the moment, one of the objectives of the government will be to try and reduce the overdraft, the amount of debt that the country has. And we'll talk about that a little bit more detail later on. But if you think about, they're trying to encourage growth, so if we don't have as much debt, they will have more money to spend on public services and other things. So they want to promote strong and sustainable growth. So we want something that's going to last long term. But they're also focused on trying to reduce poverty, and I suppose a lot of things tied in with that. So we think back to the sugar tax. Disproportionately, more people who live in poverty will eat more unhealthy foods, including high sugar foods. So therefore, by reducing poverty, by increasing health awareness, increasing the health of the nation, the government will want to focus on these sorts of things to make it a better country. So they will do this by thinking about where they spend money, how they spend money, and also, as I said before, how they raise the money that they have to spend, whether that is through taxation, or one of the other things they might do occasionally is borrow money. So if they want to have a really big drive on something, then they may go out and they may try to borrow money to pay for that. But we tend to see that more with Labour governments, where they'll want to spend more on public services and they'll borrow more. And then the Conservatives come into power usually and say, well, they've spent too much money, we've got too much debt, so we need to try and get the debt down. So it's kind of swings and roundabouts. So depending on who's in power, the focus will change. Which is why the independence of the Bank of England is important, because they're able to try and maintain a certain level in terms of the inflation rates, interest rates, things like that, that they're not at the whim quite so much of the agenda of the political party in power at the time. Okay, so again, tying in with what was discussed in the previous video, how much involvement the government will have in the economy will also be determined by the market approach in the country. So because we have a liberal market economy, they may be involved in things like providing public services, but they will not get as involved in commercial business, profit-making organisations. They will leave that much more open to the markets. Okay, so hopefully that's clear. Right, so we talked right at the very beginning about supply and demand, I think in the very first video, but we're coming back to it a little bit now and probably going into it in a little bit more detail. So there's a few different concepts that you need to understand that we're going to be looking at just now. So you look at a textbook, it's going to give you an ideal of this is what should happen. This would be the ideal of supply and demand being in perfect harmony. You've got a balance. If you imagine a set of scales, they're both equally balanced, and you've got, I'm sitting with a bottle of water in front of me, you've got 100 bottles of water being supplied and 100 bottles of water being demanded. So supply and demand is equally balanced. But in a perfect world, that would be very nice, but the reality is that's not what tends to happen. On page 225 of your current textbook, the current textbook which is the 4th edition of the David Farnham book, there is a chart or a table that highlights the key characteristics that define the different types of market competition that we have, whether you're looking at perfect competition, monopolistic competition, oligopoly, or a monopoly. Obviously, perfect competition is, as it sounds, you have lots of players in the marketplace, you have lots of business, all providing the same goods, services, whatever it is, and because there's so many of them in the marketplace, there's lots of competition, there's lots of choice for the customers, therefore there's a lot more coming and going with prices as well. Okay. Monopolistic competition, you probably still have the same kind of competition, lots and lots of businesses in the marketplace, but their products are maybe slightly different. So it would be the difference between whether you choose Pepsi or whether you prefer Coca-Cola. So something like that, where you have lots of, I know there's really only 2 there, but if you were to think of a different type of product, you maybe have lots of manufacturers all producing, in theory, the same product, but there are things that make it different. It may be different colours, different flavours, I don't know, but you know, there's lots of different ranges and lots of different products that you can pick and choose from. So although there's lots of players in the market, there are still some differences between them, so that in itself will help to establish a foothold for some organisations. Different companies may target slightly different markets, so that's where the monopolistic idea comes in, that although there's lots of competition, because they're all providing differentiated goods, they will have a monopoly in their little bit of the market. Oligopoly. The supermarkets, which I discussed in a previous video, I believe, might be a good example here, where you have usually about 5 big players in a marketplace, and those 5 players basically cut the market up between them. Okay, so you have some competition, but it's quite limited. You really don't have an awful lot of choice. But because they're all big, they won't tend to get involved in price wars because it's too big a risk. If Asda and Tesco's took on each other in a price war, for example, or if Asda and Sainsbury's took on each other in a price war, if Asda started a price war trying to put Sainsbury's out of business, for example, if they don't succeed, the consequences could be quite dire. They could put themselves out of business rather than the competition. So that's why you tend to see a lot of 2-for-1 deals and price matching and things like that. They won't try to undercut each other. They're all trying to get business by offering products at the same prices. I think Asda does slightly differently because they'll offer you, I think you get something like 10% back if they're more expensive than the competition. So they will still try to be slightly cheaper, but they're not continually trying to undercut. So that's an oligopoly where you have some competition, but really the market's dominated by a few a few big players. And as was discussed, I think, in the previous video, when you've got something like Asda and Sainsbury's talking about merging, that's reducing even more the number of players in that market, and is perhaps allowing them to dominate too much, and therefore there may be intervention. I don't know whether you can remember when Safeway got sold off and it had to get broken up because no one supermarket was allowed to own all of their branches, all of their stores, because it would give them too big a market share. So that's the kind of thing we're looking at with oligopolies, and it's one of the risks. Right, okay, a true monopoly is where there is absolutely no competition. That one producer or provider of a service is the only operator. There is no other competition. If you want, so for example, in Scotland, in England, you've got lots of different water boards. So hopefully there is some price negotiations because of the competition. I'm not too sure how it operates in England. But in Scotland, we don't have a choice over where we get the water from. The water comes from Scottish Water, and that's it. They dominate the market. There is no competition. The market's not been deregulated. It's not been opened up to competition. If you think about gas and electric, you can go where you like. You can have both provided by the one supplier. You can't get them to provide your water as well. We don't have that choice. So Scottish Water have a monopoly of the water supply in Scotland. That would be an example of a monopoly. So again, in a true free market economy, that could happen where they're allowed, where they put everybody else out of business. But it could also happen in a closed economy where the government's controlling everything and therefore the government doesn't want competition. So they may protect their markets. It's very difficult to think of companies that have a pure monopoly. It used to be, going back to the 1970s, 1980s, there were a lot of public sector providers, gas, electric, Royal Mail, all of these things where there were monopolies, but they were state-owned. And to give an example of moving from quite a restrictive mixed market economy where there was a lot of state intervention, that's what that was at that time, where there was a lot of state-owned enterprise, state-owned industries. Throughout the 1980s with Margaret Thatcher's government, everything was deregulated and nationalised industries were privatised and sold off. So that was then put into the marketplace. So moving it more towards a free market, mixed market, liberal market economy So hopefully that's helped you to understand a lot of that and put those concepts into context for you. Okay, so the other side of the coin is what happens if markets fail, or what do we do to try and make sure that markets don't fail. So when we think about market failure, there's effectively two different ways of categorising this. We have complete market failure where there just isn't the products available. You know, you just can't get something because it's not available. Or you could have a partial market failure where, for whatever reason, companies estimated the demand that there would be and got it wrong and didn't produce or buy in enough goods to sell to the public, and therefore, because there's not enough, that they've miscalculated completely. There can end up being fights over the products, or they can hike the prices right up. What happened when we had all the bad snow? People couldn't get to shops, bread wasn't getting delivered, things like that. Some stores were running out of supplies. So that's an example of market failure. Where that's happening in that kind of situation, it's short term and hopefully the economy will recover. But if it's something that's happening on an ongoing basis, then the government might want to intervene, and it can do that through fiscal policy. It can introduce taxes or incentives to sell or not sell particular products, or it can impose some sort of regulations. So, for example, to deal with unscrupulous employers. We have seen over a course of many years employment legislation being introduced, and an example in the fairly recent past would be things like minimum wage, those sorts of things, where the government is stepping in and saying you have to offer a reasonable amount of pay for someone. You can't pay them a pittance and get away with it, because it's not fair. And that would be an example of a partial market failure where, because the employers have all the power, they could get away with offering £1 an hour or something like that. And some people are so desperate for employment that they would be taking it. So the government responds and intervenes by regulating labour markets, by introducing a minimum wage. I hope that helps to put that into context. Okay, so the capital markets are the financial markets, and these are sort of the overall regulation of these is in the hands of the Bank of England. So they're making sure that the money supply within the country is working, that the financial markets are functioning effectively, that they're allowing trade to take place between buyers and sellers, whether it's individuals, companies, countries. All of this is taking place, and it takes place through the Bank of England, the stock exchange, and the commercial banks and other financial institutions that may be involved in the financial sector as well. We also have the regulation from the government and the Financial Services Authority as well. So the Bank of England, as I've said already, will lend money to the government. In bad enough circumstances, if the banks can't get money from other sources, the Bank of England is a bank of last resort. The banks can go to the Bank of England to get help, to borrow money if they need it. But obviously the banks should be lending to each other. And the stock exchange is also used by companies selling, buying shares on the stock market as a way for them to raise cash as well, a way for them to raise money so that they can invest further in their business, whether they're looking for expansion plans or whatever. Buying and selling shares on the stock market is to allow the companies to generate income for themselves as well. So when companies are looking to raise money, sometimes they'll go to the banks, but they will also use the stock market for that purpose. But small businesses and you and I as individuals, we want to raise money, we have to go to the banks. We have to borrow from the banks. Okay, so the Bank of England's role is to make sure that all of this is functioning properly, that the stock exchange is considered to be as safe as it can be. There's obviously a risk, as we know, whenever you're buying shares, there's a risk that the share price can go up or down. But the financial services need to have the Bank of England regulating it, controlling it, making sure that it's functioning effectively. The London Stock Exchange is perceived as being probably the best in the world. So they want to keep that reputation. They want to be at the forefront. And particularly, as I mentioned before, coming out of Brexit, we want to make sure that it's continuing to work. Likewise, the banks, they have to be confident that they'll be able to lend money. You think about you paying £100 as part of your savings. The bank doesn't hold on to that. The bank, when it gets money in through savings, it's giving that money back out through to borrowers. So they need to know that they have the cash to provide. And that's what happened with Northern Rock back in 2008. Suddenly people weren't confident. People were worried. So everybody was queuing up outside the Northern Rock to get their money back. And the Northern Rock didn't have that kind of money on tap. They'd been lending it out to everybody else for their mortgages, so they didn't have the money, so they had to turn to, effectively it was the Bank of England that bailed them out. And we've seen that as well with the fact that the Royal Bank of Scotland and I think Lloyds are partly owned by the government now, partly owned by us. That's why that's happened, because they had to be protected. Okay, I think I've mentioned some of this already. So these are the other things that the Bank of England does. It manages the UK's foreign exchange, so the exchange rates between different countries. Gold reserves. The gold reserves are the gold that the country actually holds to provide a sort of underwrite the value of the money that's in currency, the money that's in circulation. The government has a stock register. The government owns stocks, so the Bank of England keeps a note of what they are. It issues banknotes and it fixes interest rates. Yeah, I have talked about all of this already, so I'm not going to go back through it. But if you do have any queries, you can ask me in class. Right, quantitative easing is where the government is putting more cash into circulation so that it can encourage people to spend more money. Okay? So it does that by, if we think back to the last Labour government when they were borrowing money, they were issuing treasury bills, I think they're called. Basically, they would offer, companies want to borrow money, the government would sell treasury bills, and companies would buy these treasury bills, or the banks would buy these treasury bills and give the government money. So they're then able to put that money into circulation. That's effectively what quantitative easing is. The government's getting in money to be able to spend more. No, the other way around, sorry. Quantitative easing is where they're putting money in, so they're actually paying back. So they're collecting back in those notes. So they're saying, right, okay, we gave you the bills, here's the money back. So they're putting the money back into circulation. So they're actually buying back up their treasury bills. So that's just saying, you know, that £10 I gave you, well, can I have it back? And here's the money back. Okay, it's maybe not £10, but you get the idea. So they're not taking the money out of circulation, which is what I was describing before, but they're putting the money into circulation, so they're buying back up the loans that they had taken out, so they're paying off their loans and putting money back into circulation. Right, labour markets. Discussed this already. I think going back to the first video. Supply and demand of labour. So it's exactly the same as supply and demand generally with economics. The supply is the amount of people available for work, the amount of labour available, and the demand for labour is the amount of jobs that are available, the employers looking for employees to fill the vacancies that they have. So national labour market is not the same as the unemployment rate. It's not just the amount of people that are unemployed, it's the working population. It's the amount of people of working age who are able and looking for work. It doesn't just mean, they're not looking for work, it can be people in employment. So anybody that is able to work, who is of working age. So it could include people who are not registered unemployed but are still perhaps looking for work. So it's a bit different from the unemployment rate. Things to think about as well generally are how work is changing, how the nature of work is changing. I've already mentioned the move from production industry to the service sector to the knowledge economy. Those changes will change the type of work that's available and the type of skills and things that are needed for the labour market as well. Changing patterns of work. Obviously the big thing just now is the gig economy. So much more flexibility, much more 0 hours contracts, much more self-employment as well. And something to look into, but it does seem to be, debate as to whether or not it's relevant anymore, is the hourglass debate, where it was argued around about 2000 that the way the economy was emerging, we could end up with a labour market that looked like an hourglass with very high skilled people at the top and very low skilled people at the bottom, but in the middle there's nothing for those people with kind of moderate skills levels. But there is some evidence that suggests that perhaps that's not the case anymore, and with the stock market collapse and things like Brexit as well will be impacting on all of these things, so there may be changes. So it's always worthwhile being aware of what the current trends are. CIPD have some research ongoing into these areas of future of work and things like that, are CIPD projects that it may be worthwhile looking into as well. And that's us finished our presentation and finished the chapter on markets and the competitive context. I hope that it has helped you understand more of what's in that chapter.